Good afternoon, everyone. Thank you so much for joining our webinar. We're going to wait a few more minutes to let more people join in, and then we're going to start officially. All right, we're going to start now. A lot of people have joined in. Thank you so much for joining our session. As a few of you might know that we have done an introductory webinar on corporate tax before as well, where we briefly talked about all the aspects that are related to corporate tax, and we discussed the introductory and preliminary facts that are known up till now. But in this session, we're going to talk in detail about the further aspects of corporate tax, how it is going to affect certain entities, and what are going to be the detailed characteristics of corporate tax. Before that, for those people who could not join our previous webinar, I'm just going to recap about corporate tax quickly so that people who are not familiar to it, they can get an understanding about it. As we all know that in the beginning of this year, in January, federal government, they announced the implementation of federal corporate tax regime that is going to commence on or after June 2023, depending on the financial accounting period of the businesses. Now, the taxable period, by default, it will be January to December, unless a business has their own accounting period that they follow. For the taxable income on which corporate tax is going to be levied, that is the net profit of the business that is depicted in the financial documents of the business prepared in compliance with the federal and accounting regulatories that are applied in UAE. The threshold for the taxable income is 375,000 dirhams. Any income that is below this threshold will be rated at 0%, and any income above this threshold will be rated at 9%, which are two rates for corporate tax. When it comes to exemptions for corporate tax, they can be widely categorized into the following, which are businesses that engage in the activities which is basically extraction of natural resources, free zone companies, where the free zone companies are exempted from corporate tax, but there are certain conditions which we're going to talk in detail later on in this webinar, and then all of the individual income. And one more important thing with corporate tax is that OECD transfer pricing rules are now applicable, which we're also going to talk in detail about in this webinar. For the details, I'm going to hand it over to Mr. Haseeb, who is our co-speaker. And after that, we're going to hold a brief Q&A session. So during the session, please make use of the comment section below to shoot your questions that we will address towards the end. Over to you, Mr. Haseeb.
Thank you so much, Maham, for giving us a brief overview of the corporate tax that is going to be introduced in, of course, in a couple of months now. Uh, as Maham has already explained about what corporate tax as a general is and when it is going to be applicable. This corporate tax, as we all now know that it is going to be applicable for financial years from June 2023 onwards. In our previous sessions, we already discussed about the general overview of the corporate tax. Of course, there are many in-depth areas of corporate tax that needs our attention, and we couldn't go in details for those related to those topics. One of the topic that we need to go in details is transfer pricing, and today we will be discussing in detail about impact of transfer pricing on corporate tax regime. With corporate tax uh, being introduced in any country, of course, we know that corporate tax applies on business profits. And to reduce business profits, sometime the related parties, they do, maybe they purchase from a related party, and which will eventually reduce the profits of that entity. So to avoid that and to combat such practices, OECD, which is Organization for Economic Cooperation and Development, has introduced worldwide transfer pricing rules. Transfer pricing rules means that uh, whenever there is a transaction between related parties, the transaction should not be influenced because of the related parties' relationship with each other. For example, there is a related party A and there is a related party B. If party A purchases from party B, maybe party A, the amount the amount that party A purchases from party B, it could be maybe inflated or deflated. It is to reduce the profits for the party A. To avoid that, there are certain rules and regulations that needs to be followed. So we have discussed what transfer pricing is. These are the transactions related between incurred between the related parties which have common ownership or control. Of course, the transfer pricing rules are applicable to ensure that the economic output of the transactions are not influenced because of the relationship between the parties. Now, what are the related parties for the purpose of the corporate tax? The related party, as a general, means that it could be an individual or a legal entity uh, which has indirect control over the associated party with whom this transaction is happening. For example, uh, there's a group of companies A, B, and C, which is owned by a parent company D. So any transaction between company A or company B will be considered as transaction between related party, and the transfer pricing rules will be applicable. Now there are a few more specific scenarios or descriptions for related parties. Related parties could be taxable person, an individual, like an individual and legal entity uh, owned by an individual, and that individual could maybe it up to fourth degree of kinship or relationship. For example, I have a company, then my cousin has another company who is maybe my uncle's son. So that will also be considered as a related party because as an individual, uh, I have a relationship with that individual, that company's director or the person who is controlling it. And also, for example, there's I have a company which I am dealing with, but that company may be with me or from my related party. if I own more than 50% or greater shares, that will also be considered as a related parties. Uh, this is a broad definition for indirect ownership and control over the associated party. However, we are expecting that detailed definition for indirect ownership and control will be introduced by FTA related to these transfer pricing rules. Because as of today, the FTA has not yet issued officially a public law. The points that we are discussing today are based on the consultation document that FTA had sent to us or other tax agents and consultants for discussions. So these are the points which will, of course, because these are global points as well. So of course, UAE has to stand itself as an international platform. So it will also be implementing the same transparent rules as are already implemented worldwide. So now we know that what transfer pricing is and to which transaction it does apply. So transfer pricing, just to summarize over these 2 points, transfer pricing means that whenever I am, as a company, dealing with any other related party, the transfer pricing rules will kick in. And now, what are those related parties? Related party means any company which is controlled which is controlled by directly or indirectly by myself or my any other related party. So now we are going in depth. We will go in depth about what transfer pricing rules are and what documentation is needed for that, and how, as a company, we should abide by those transfer pricing rules. So we already, of course, discussed about related parties types. So these are, for example, partners of unincorporated partnerships. If I, as a person, all my businesses may be exempt or non-exempt, those will also be considered as a related party. So a single individuals having maybe different companies, these all companies will definitely be considered as a related party for corporate tax uh, regime. Now, elaborating further to that, our point regarding the transfer pricing rules, we have the basic purpose of transfer pricing is that whenever I am dealing with connected persons, like connected person is an alternative word for related party. So those payments that are being made to connected persons will be deductible for corporate tax purpose only if these are based on market conditions. These should not be artificial transactions just to reduce the profits. So, for example, if I am getting, I am a, let's say, a trading company, and I am getting, let's say, market research and development services from my other related party, whatever transactions I am having with that company should not be influenced just to reduce my profits. One more point will also apply here as a connected persons. So, for example, a director of the company, director or shareholder or owner of the company is having any transaction with the company, such as management remuneration, maybe he's withdrawing, he's saying that as a director, I am giving such services to the company. If he's charging a lump sum amount, this amount should be as per market based. It should not be just for the sake of reducing profits, and the transaction should be independent. It should not be influenced in any way. So for transfer pricing, uh, arm's length principle is used widely, which states that uh, all the transactions happening between related parties should be done at arm's length. Arm length, if we understand it in a simple word, it means that the transactions should be happening between related parties as if they would have happened between any other independent uh, enterprise or uh, entity. So if I am buying something from my related party, my group company, the fee or the price that I am paying for the goods that I'm getting, this price should be same as I would have paid if I would have bought these goods or services from any other company in the market. OECD has specific guidelines on transfer pricing, which we will be discussing in next few slides. Those are the methods that the company should follow whenever there is a transaction happening within the group companies. The core application in arm length principle is comparability analysis. Comparability analysis, as I have already, in simple words, I have explained that it means that the transaction should be comparable. Like, for example, if I am dealing with any of my related party, uh, the transaction should be comparable with any independent authority and independent entity as well. Some of the comparability factors uh, should be like contractual terms. Whatever the terms I am having in those transactions should be terms uh, as per industry practices. And whatever functions are performed by each party should also be comparable. Like, for example, let's say if I am doing, let's say, marketing services for one of my related party, the function is of course comparable. We can see that if we do a market research, uh, we can understand that there are many companies providing market research, and if we are, let's say, paying $500,000 for market research to our related party, that $500,000 for that particular service that we are getting from that related party should be the same as if we go into the market as an independent and we get those services. So characteristics of the property transferred or provided services, like whatever we are getting, for example, if we are getting marketing services, maybe we are getting human resource management services, administration services. So whatever the characteristics that should be documented and in the transfer pricing. And of course, the economic circumstances of the market. For example, let's say I am from my related party, if I am getting the services worth $200,000 for, let's say, office management or as a head office management. Uh, the same services, if I go to another service providers, it should be same. Like, for example, if there is a recession going on in the market and because of the recession, the prices have gone down, but I am getting the service for, let's say, 500,000, but for the same service, uh, that is available in 200,000 or maybe 100,000, one fourth of the price. So that means that the market circumstances or the economic circumstances of the market does not uh, allow me to, as per transfer pricing rules, to have such lower prices for the services. And the business strategies pursued by the parties, of course, whatever business strategies that we are dealing with, that should be as per. These are some of the comparability factors that we will account for when we will be comparing over transactions with the market practices. So now going further into details about the transfer pricing methods, these are some of the methods that have been outlined by OECD guidelines, and these methods should be referred to by by the companies who on whom the transfer pricing rules applies. So all the methods, we cannot say any method is good or bad, but uh, it applies to different circumstances and different scenarios. So the companies involved in uh, related party transactions should choose the transfer pricing method most suitable to them. And of course, we will, in the next few slides, we will understand that why it is important to choose transfer pricing method, and its documentation should also be kept. So first one, we have comparable uncontrolled price, CUP, which means that any transaction on which transfer pricing rules applies, uh, it should be uh, uh, it should not be influenced. So, for example, if company A is buying from company B, which is a related party, of course, for let's say market research services, for let's say again we will talk about, we will take a number, $250,000. Company B is charging $250,000 to company A for market research. But let's say if we go out in market and check the prices for same market research, it should be $250,000 for the same type of services, the characteristics and whatever services that we are getting. So that is uncomparable, uncontrolled. So it means that we should have, once we decide a transfer price between the related party, that transfer price should be compared with an independent um, service provider or goods provider, like I mean, whatever the transaction we are having, maybe goods or service, it should be comparable. So that is the rule one for to determine what prices should we buy or transact those goods. So then there is a resale price. Resale price means that if I am buying from my related party a product, uh, then I need to check that if I will resell this to my my customer, to the end customer, how much that customer will pay. For example, let's say I buy from for $100,000 worth of goods from my related party, and when I go to market, the price for that uh, goods I can sell for is maybe $110,000. Of course, I need to keep my margins. So in this resale price, first we arrive at a resale price. So for example, I buy for five, let's say I take the goods from related party. I do some market research and then see how much it will be resold if I buy from a party, related party, and then resell it. So maybe if it resells for let's say $110,000, then I will rework my cost. So, for example, if I say that maybe if the reselling price for that product is $110,000, so maybe my admin cost, my selling expenses are let's say $8,000 market research, and then I have to keep let's say 20% margins or 10% margins depending on your industry. Uh, then I come to the point that okay, my cost should be let's say 98. So then we will using this methodology for transfer pricing, we will determine that the value for this particular product or service should be 98. So because I will buy from my related party for 98, and then I will keep some of my let's say my margin for 10%, and then my selling cost that I anticipated and expected before, and it will be sold for 110,000. So we have arrived at the price. For this is the resale price method. So this resale price method is normally used by resellers and distributors. Uh, this resale price is normally used by distributors and resellers. So other than not the manufacturers. So as I have explained earlier that there are different transfer pricing methods, and each one should be the company involved can choose any of the method, but it should be relevant method, and the reason it should be. Then there's a cost plus method, which means that whatever cost, uh, let's say uh, I have manufactured a product for, let's say, $60,000, and I will keep, let's say, 20% or 15% margin on that, and then maybe I will sell it for, let's say, if 10% is margin, 66. So my cost first I determine cost, and then I determine the a reasonable margin, and then on that basis the price for that service or product is determined to be 66,000. So these are just, of course, numbers as an example, and we could have different products and services, and accordingly we will be determining the price using the cost plus. So briefly recap for these three in simple words. Comparable controlled uncontrolled price means the price when compared with the market conditions, that should be our transfer price. That is the comparable uncontrolled price. Then there's a resale price, which is normally used by resellers and distributors, in which first I determine the resale price. If I buy, how much it would be sold for, and then I will rework back to my the transfer price that I should buy from my related party. Then there's a cost plus, in which we keep our first we determine the cost, and then we keep our margins. Then these were the traditional transaction methods. Then there is a transactional profit method. So first one is profit split methods. So let's say, for example, I'm having let's say $100,000 of transaction between my related party B. uh, I am party A. If I buy from party B 100,000 worth of goods, and then I sell it for, let's say, 110,000 to a party C, which is unrelated. So my margin in that is, let's say, 10%, because I bought it for 100 and I'm selling it for 110. So we also need to check how much the margin is for our related party. Maybe the related party manufactured it for $50, $50,000 in this 100,000. So we can see that there is unreasonable difference between my profits and my related party profits. So maybe my related party is making 100% of the profits, and while I'm making only 10% of the profits. So this profit split method also could be used to split the profit between the related parties, and whatever margins, the profits that are each related parties having, it should be reasonable as per market. Then there's a transactional net margin method, which is only related to the single party. So before we were splitting the profits between different parties in these transactions, um, we will see, like, for example, if we are buying some goods worth 100,000, and we are selling it for, let's say, $106,000. So it means that my margin is 6%. So that 6% margin that I have should be as per market. So for example, if in the same transaction for the same goods and services, the uh, market as the margins as per market research are maybe like 20% and 30%, and I'm keeping only 6%, means that there's some problem. The transaction is some sort of influence, and we need to apply transfer pricing and to rework over transfer pricing, so to arrive at a price which should be reasonable and should be at arm's length. I hope these were some of the transfer pricing methods that we discussed, and we have seen that these apply to different uh, entities and having different scenarios. There is no right or wrong, but it depends on which method is suitable for which industry. Now, moving forward, we have discussed about transfer pricing, what transfer pricing is, to which companies it does apply, what are the transfer pricing methods. Now we will be moving forward to transfer pricing documentation. So transfer pricing documentation, it is very important, especially when the corporate tax um, will be implemented next year. So whenever there is a transaction between related party or connected person, a proper documentation should be maintained. It must be maintained, and because FTA authority could be uh, whenever they will maybe they will do audit. They can require or ask about documentation. So you are required, if you are involved in these transfer pricing regulations, you are required to just keep these documentation. If there is a multinational company, it should also submit a notification to Ministry of Finance or FTA for country by country reporting. Country by country reporting briefly, it means that whichever company, whichever countries a multinational company is dealing in, its revenues, its profits, its business operations geographically, country-wise, it should be reported how and how much tax that multinational company is paying in each constitution. This country by country reporting, which is influenced by, of course, transfer pricing, which is also included in transfer pricing documentation, it should be filed within 12 months following the end of your fiscal year. Uh, the document also states that you need to maintain a master file and a local file. Uh, we will briefly discuss what are the things that are included in master file and local file. So these are, of course, documents that are required to be kept for transfer pricing purpose. So there is one master file, which includes organizational structure. Of course, there are certain more requirements and details about what should be included in, but what should be included in organizational structure. To briefly telling you, it should include the like charts, the organizational structure, geographical locations of the business, in which country the company and the different group of the companies they are operating, their management structure, then descriptions of multinational businesses, the key profit driving points, what are the factors, their supply chain, the intercompany financial operations means that if the group companies are being financed by any particular one central company, the information related to that must also be maintained. And the intangibles assets, like for example, research and development, capitalized expenses, patents, intellectual property, all the details related to those intangibles in a particular format uh, must be maintained in the master files. Then we have consolidated financial statements that must also be maintained, and whatever taxes we are paying as a multinational, as a company in different countries, details related to those taxes should also be maintained. Of course, this is a very detailed file, and it has a predetermined structure and how it should be maintained. There is a complete set of guidelines from OECD to maintain these master files, and the businesses should follow those guidelines to avoid any non-compliance issues. We talked about master file, which is as a whole, as a general, we can say, for all the overall business of the group company, and then there's a local file, means that the local entity, this will mainly apply if we are talking about UAE, it will mainly apply to the company operating in UAE. So the description of the local entity, including the business, the management, and whatever details of the local entity, the financial information, The accounting records, if there is an audited financial statements available, those must also be kept, and whatever transactions are being happened are occurring between local entity and the other maybe foreign related party, or between the local related party, but the information related to that must also be uh, maintained in the local file. So there are some of the risk factors related to the transfer pricing, especially intra-group transactions. Um, and if, of course, the rules and these regulations are not followed, there are extensive fines and penalties. Uh, so you must, if the transfer pricing rules apply to any company, the company must maintain a proper set of documents, and it should follow a certain procedure for transfer pricing. Otherwise, it could be subject to different penalties ranging from 10,000, and these are some of the penalties that you can see on the screen. So it is very vital for any company who is falling under the scope of transfer pricing to maintain uh, proper documentation, and the rules related to transfer pricing must also be followed very carefully and extensively. That must be maintained. So that was it for transfer pricing. I hope I was able to explain uh, in as much detail as possible in this limited period of time that what transfer pricing is, on which company it does apply, what are some of the transfer pricing methods, and what is the documentation requirement uh, for the companies who are engaged or to the companies to which these transfer pricing rules apply. Now, our second topic for today is free zone applicability, and uh, I can see that we received initially, as well as this is the point where, especially in Dubai, most of the companies are concerned about being a free zone company, whether how this corporate tax is going to be applicable to. So the good news uh, is, as per the consultation document provided to us by Federal Tax Authority, all the free zones, of course, they have a pre-existing agreements with companies which are established under free zone, that they will be tax-free. They will not be subject to tax for maybe 100,000, 100 years or 150 years. So they will continue to honor those agreements. So this is a sigh of relief for the people who are maybe engaged in free zone companies. Of course, there are some of the rules, regulations, some of the things that being a free zone company you need to follow to enjoy your status as a 0% corporate tax. So any transaction being a free zone company that is happening outside UAE or within free zone, that will be subject to 0% corporate tax. So when we say that the corporate tax does not apply or is a 0% for free zone companies, it does not mean that the corporate tax rules and regulations does not. Of course, corporate tax is a federal law, it does apply to you. You need to do all the compliance, you need to do all the required, you need to all the required documents and everything you need to maintain. But at the end, if you follow a certain business guidelines and you are doing your business in a certain guidelines, the corporate tax will not apply to you. So let's say if you are a free zone company, you have a mainland branch. So all the income that is earned from mainland, that will be subject to corporate tax. However, your free zone income related to that free zone entity should be subject to 0% corporate tax. Any passive income earned from the mainland, that should also be subject to 0% corporate tax. Passive income means that that is just one-off income that you earn, that is not your regular course of business. Transaction between free zone companies and their group companies in mainland, So any those transactions, if the economic benefit relates to mainland companies, that particular portion will be subject to corporate tax. And then if you are selling goods to UAE mainland from designated zone, being a free zone company, you should not be engaged with mainland businesses. Otherwise, you will lose your status as a 0% corporate tax applicability, and then you will have to pay tax, corporate tax on your entire. Let's say, for example, uh, 99% of your transactions are within free zone or maybe outside free zone, but maybe 1 or 2% of the transactions you have mainland, you will not be able to enjoy 0% corporate tax, and the corporate tax will be applicable as an entirety on the entire uh, economic operations of the business. So this is very crucial point for businesses who are engaged in free zone operations as well as in mainland. So uh, uh, you may need to think of restructuring your business so that you are able to enjoy 0% corporate tax benefits on your free zone operations. Any other mainland source of the income, it is full taxability, as we have already discussed. And then, of course, the audited financial statements are already mandatory in some of the free zones. Then it will, even the free zones which are sort of flexible about audited financial statements, they will also start to require audited financial statements. But to summarize my point related to this free zone applicability, corporate tax as a general rule does not apply to free zone company um, unless they are doing some mainland business. So if you are only dealing in free zone, corporate tax will apply, but as a 0%. Of course, we have already discussed that any mainland sourced income will disqualify a free zone person from the 0% corporate tax regime in respect of all their income. So, for example, if you are making 95% from free zone, 15% from mainland, you will pay taxes on your entire income. Free zone person will at any point in time be able to make any report. So this is I don't think so any company will make an election, but unless maybe there could be some circumstances. So a free zone person can also make an irrevocable election. So maybe a free zone company can say that okay, uh, uh, because of certain reasons, I want to pay the corporate tax, and this will apply to all the free zone company will no longer be enjoying its benefits as a 0% corporate tax. So this was it. So we briefly discussed about uh, corporate tax as a general. We discussed about the transfer pricing rules, what are transfer pricing rules, which companies they will apply to, and uh, what are the methods that are used for transfer pricing, and how it is going to impact free zone companies. So now we will move forward to some of the question answers that we have received uh, from our registrants, and we will be answering those questions. Maham, I think we have some questions that were asked. Um, you can move forward and we can answer those questions.
Yes, thank you so much for such detailed session, Mr. Haseeb. On your screen, everyone, you can see our contact information as well. You can scan the QR codes and save our contact information in case you have further queries or concerns and you need to reach out to us. We are first going to address the questions that we received through our registration forms and the FAQs that we received on our other social platforms, and then we will address the questions that we have received right now in the session. So the first question that we got, Mr. Haseeb, was that what will be the allowable and not allowable expenses for the calculation of taxable profit?
I think this is very common question and asked mostly by many people. So allowable expenses, as a general rule of thumb, means that all the business justifiable expenses will be allowed to be deducted with regards to corporate tax. But any non-business expenses which are influenced just for the sake of reducing profits, these will not be allowed by FTA. However, the details of such expenses are expected to follow from FTA's future guidelines. But as a general rule of thumb, all business expenses are allowed to be deducted.
All right, perfect. Next question is that is there going to be any upper cap on managerial remuneration for allowances as deduction for tax?
Maham, I think that point I already discussed as well when we were discussing the connected person slide. So a director is also a connected person for the business. So as a general rule of thumb, the remuneration should be justifiable. You cannot make any unreasonable remuneration just to reduce your profits. So let's say it also depends on the qualification, the experience, the expertise, the work that particular director is doing for the company and the value it is being added to the company's operation. Uh, so there is no defined upper cap limit, but I can say that with confidence that it should be market justifiable. It should not be just for the sake of. But to answer your questions, there is no upper cap limit.
All right. And we have received quite a few questions regarding the tax groups. So, will there be any tax groups for the purpose of corporate tax? And what will be the process of their tax registration and filing the return?
Tax registration procedures are yet to be announced by FTA with regards to tax group or even individual companies, and we expect them to be uh, maybe in a couple of months. A portal will be published, launched by FTA for the normal registrations and tax group registrations, especially for tax group. I would briefly let you know that being a tax group, your intercompany transactions, of course, will be eliminated. You need to appoint a representative for the tax group. The member companies needs to give an NOC to a representative to represent as a whole. There are certain benefits and advantages and disadvantages for a tax group, which we already discussed in detail in our previous session. Uh, However, a tax group it varies. Like for example, uh, the benefits could be maybe you will only need to file only single corporate tax file. You will have, let's say, lesser administrative burden, but you will have more compliance requirements because in the tax group you will need to maintain all the transactions happening between groups, and uh, any penalties that could be due will be severely applied to all the companies in the tax group.
Right. And we have talked in detail about free zone companies, but there was a specific query of the applicability of corporate tax for free zone companies that have transactions with offshore companies.
Offshore companies, as we already discussed, Maham, that any income as being a free zone company that is with either within free zone or outside UAE, it should be subject to 0% corporate tax. Any income or operation related to UAE mainland will only be subject to 9%. So if you are dealing uh, not UAE companies, then all the transactions will be subject to 0% corporate tax.
All right. And one more question that is related to free zone, but it is of a different nature. That if a person has a freelancer license from free zone, will the corporate tax be levied on their income as well?
Maham, there is with corporate tax and tax laws point of view, any individual or legal entity, they have the same rules. So, for example, a freelancer, an individual having a license from free zone, and we can also maybe when the person has an agreement with the free zone for the license, you can see in his license that the free zone are mostly offering an agreement where they are exempting the licensee from corporate tax. So if that company or person is again dealing with free zone and outside UAE, it will not be subject to corporate tax. Only the transactions that are happening in UAE, those should be subject to corporate.
And one more question we have is that if we currently have any information on the export-import transactions that are not related to parties, and whether the same approach will be applied or for the transactions that are out of scope outside of Gulf countries as well.
Import export, we need to see if whether we are uh, exporting from mainland or free zone. Again, if we are exporting from free zone and all our transactions, 100% of the transactions are exported from free zone, then it will be subject to corporate tax rules and regulations, but the corporate tax rate will be 0%. And of course, as the question the guy has asked that it is not happening, we are assuming that it is not happening to a related party. If it is not happening, the transaction is not happening to a related party, normal corporate tax rules will be applicable. But however, if it is the transaction is being incurred between any related party directly or indirectly, it should be subject to transfer pricing rules.
Right? And we have already discussed about the tax rates and the thresholds, but maybe a few of individuals they can be confused about it. So the question is that is there any tax slab specified for corporate tax, or is it just the rates that we have?
There is a threshold limit for up to 375,000 dirhams. The net profits should be subject to 0% corporate tax. So let's say if you have 400,000 of profits, only 25,000, that is over and above 375,000, will be subject to 9%. The remaining 375,000 will be subject to 0%. However, you will still need to do the corporate tax registration. You will still need to follow all the guidelines, the requirements, and to satisfy, for example, if tomorrow FTA is asking about to justify your status, you should have all the supporting documents and regulatory requirements.
All right. And there's one more question that is more related towards the normal accounting side. That can bad debts of previous years be posted to the year 2024 once the corporate tax will be effective?
That's very interesting question. However, if the sale was happened um, after the effective date, only those bad debts will be considered as a that can be adjusted against the profits. However, if those were before the application of corporate tax, those will be non-deductible. However, being said that, official FTA's laws is yet to be announced. We can expect a different approach, but as per my knowledge and experience with other countries, laws and regulations, especially with corporate tax, it should be only allowed if the sale was happened after the corporate tax.
Right? And we have one more query regarding the free zone companies. that when a free zone company they have investments overseas outside UAE, the income and the capital gains from such overseas investments, how will they be applicable when it comes to corporate tax?
Or any income for prison company that is outside UAE, especially the capital gains, these will not be subject to corporate tax. So it's a very clear that as per the consultation document received from FTU, these will not be subject to corporate. Even the capital gains within UAE, if that is not regular course of the business, for example, if I have investing in shares and if there's a capital gains and dividends, those will not be subject to corporate tax.
Right. Those are all the questions that we can address right now. But I can see in the comment section that there are a few queries that are extremely custom to a typical industry and a typical type of business, and that will take a lot of detail. And there will be a few cross questioning that needs to be done in order to answer those queries. So for all the queries that are very custom tailored to a typical kind of industry, we will personally reach out to you guys on your email addresses and try to address them. And if you guys have any other queries or concerns, you are free to reach out to us on our email addresses or on the contact information in front of you to get your queries addressed. Thank you so much, everyone, for taking the time out for our sessions. I believe that it was helpful and you guys got to learn something. We will be doing a few sessions in the future as well on different other topics. So keep an eye out on for that, and you can follow us on all of our social media platforms for our upcoming webinars. Thank you so much. You all have a great rest of your day. Bye bye.
Bye-bye.